Hello everybody and welcome to Trade These Stocks for our weekly analysis video. So this one is for the week of January 26th, and it is already 2015, and this is a special report because, as you might have noticed if you follow me, I haven't been around for a while, so I'm finally coming out of hibernation, and lo and behold, it's 2015. And what better time to be in the markets than right now? Right now we have this amazing volatility that we haven't had in a long time. Having said that, I will also say that it seems that people got bearish suddenly, which is the truth. The market is at the moment very bearish, but you also have to look at their sentiment. Sometimes bearishness can overshoot, and that's when you have to be a bull. So now our question is, at what point do people feel too much fear so that we can start buying the market? Of course, we take it one day at a time. It doesn't mean that the market's not going to be negative for the whole year. We just don't know. But for the time being, we are looking for that low. And it has been very difficult just based on news, and it seems that the currency wars are finally emerging, which is something that we should have expected just because of all this debt that is piling up in the world. And of course, most of the debt is denominated in US dollars, and so we have this, so to speak, short squeeze going on. So think about it. If you are wrong on a trade and you're short, right, and then all of a sudden it goes higher and higher, what happens? You want to get out because there's essentially no ceiling to how high it can go. And it's the same thing with these people, or instead of people, let me just say these governments having all this debt. So what's going on is most of their debt, whether it be Japan, Europe, or Southern America, it doesn't matter. The whole world is pretty much in debt. And so imagine it as having a lot of short sellers, and all of a sudden they all want to cover, right? So we're having a short squeeze, but it's on the dollar. And so the dollar is a great opportunity to go along. Of course, wait for a pullback. You don't want to pay up for it. But just based on looking at what's going on in the world, if you're somebody who just likes to invest and just sit tight and do other things in life, then by all means, the dollar is going to be a good trade. It's going to be a carefree trade just because of the timing of all these different QEs. So the United States is pretty much done with QE, and it seems that we are pretty much the only country in the world where it has had an impact. Now granted, there are some bad things. For example, we're not seeing earnings go up, we're not seeing quality jobs, but we're still seeing an improvement. Okay, so you can argue all you want about how they measure the unemployment rate. The fact is that among the worst, we're the best. So that's kind of how you have to look at the economy. Nobody's really that well off in the whole world, but we just kind of, we're the best out of what's out there right now. And so yes, we're all printing money and we're putting our future generations in debt, but we're doing it in the best way. So yes, we're doing an evil here, but ours seems to have sort of worked out in the best way. And you know, I don't think our next generations are really going to pay off all this debt. Probably the quality of life will have to suffer a little bit, but there's always a way around. With these politicians and these bankers, they're going to find a way around. Once they get their money and they notice that the consumer isn't spending anymore, some of this debt will just have to be forgiven because it's just getting out of hand. But long story short, what I'm trying to say is that most of the debt in the world is denominated in US dollars. And so as a result, we have this sort of short squeeze. And so that's why a lot of these currencies are being devalued. That's why you're seeing the euro essentially almost being on par with the dollar. Also, the dollar yen has just been parabolic. Now you need about 118 yen for $1, whereas if you just go back 3-4 months ago, it was worth about 20% more. So in terms of currency, that's a big swing. And if you're a country that holds a ton of debt, and all of a sudden your currency loses value against the dollar, that just means that you owe more. And it's sort of a ticking time bomb. So the dollar is going to continue going higher, no question about that. And these countries with all this debt, the sooner they start paying it off, or at least hoarding the dollar as a reserve in their own stocks, the better it's going to be for them. And so that's essentially what's happening. The whole world is buying dollars because it's the safest thing out there. There's a lot of debt. Debt is denominated in US dollars, so we're essentially having a short squeeze. Now, of course, a strong dollar is having some repercussions elsewhere, namely commodities and earnings. And so when a dollar is strong, especially when you're an overseas company, it just means that you're not really getting a lot of money back in earnings. And so all these companies like McDonald's or Google, they're struggling. They're struggling because they can't make the same money that they used to. So because of the strong dollar, these companies really aren't having the revenues that they should. So of course, when you wake up in the morning and you notice that 5 different companies all had bad earnings, which is something we haven't seen in pretty much over a year, it's a shock really to the stock market. And so what happens is that people start panicking, they start selling, and we have been seeing a lot of distribution. So most of the selling is actually the big funds selling, and it's been happening very quickly and very suddenly. Another thing that I also mentioned, so the first thing was the earnings. The second thing that is affected by the strong dollar are the commodities. Just look at oil, where oil is. And so yes, it's good to talk about oil being low, but the underlying problem here is that the dollar is very strong. So that's sort of a side effect of what's going on in our economy. You can't fix everything. So it's just something that we'll have to get used to. So we just don't have QE anymore. The Fed raising interest rates, that's probably not going to happen, and the market is already pricing that in. And that's why, so let me look at some charts so you're not looking at this all the time. So if you look at the spiders, so I'm looking at the SPY ETF. So the Federal Reserve had a very interesting event on Thursday. And what happened on Thursday was that at 2 p.m. they had a statement out where they just reiterated that they would be patient, and or was it Wednesday? I'm not sure. Might have been Wednesday. But they reiterated that they would be patient in raising interest rates, and that was it. It was a very short report or whatever they had out. But the market has been, especially since here in December when we had the biggest move based on their patience comment, the market is used to rallying whenever the Federal Reserve says something. So this time around we sold off. So this was a change in character. This was something that we haven't seen in a while, and even our MACD and our stochastics have crossed over into bearish territory based on this. And so what this is saying is that now, relatively speaking, the patient comment just doesn't do it anymore. Because now we have this announcement of the European ECB bank doing quantitative easing. We have Japan printing money like crazy. And so it seems that the world is ramping up to this huge QE deal, because it seems that we need another round of QE. And that's why countries in Europe, if you look at Germany, for example, their DAX, their stock market is doing wonderfully. It's very difficult to figure out where the top is. They're doing very, very well. And we, on the other hand, are turning lower. Now, of course, we are the world leaders, and we would probably be the ones to turn around. And so we're seeing that, but I'm still not convinced that this is it. I'm thinking that we probably have another move up, but that the move will be rather weak and short-lived, and then immediately we will have a drastic A-shaped downfall. Um, so what's been happening is that the market just doesn't like these comments anymore. So the only way that the Fed now could push something is if they said something along the lines of employment, wages rising. That's something that consumers, that the economy has been concerned with. Then also to look at the consumers, because that has been a little bit weak. So these are the two things that could convince the market to go higher. And of course, if we announce something like Europe, like a QE, which is not going to happen. So just saying raising rates is not going to happen for now, we're going to be patient, that doesn't cut it anymore, because the market has caught on to it. The rest of the world, some of the countries even have negative interest rates, which just goes to show you how desperate they are to fix their money supply. And what's happening with us is that we're doing so well that it's actually bad for us. So there's your thing. So the money is not there as much as it should be. So we're now just basically a safe haven. So people are putting money into the dollar based on these currencies. And I'm thinking that probably sooner or later the dollar is going to have to decouple with the market, meaning that the market's going to start going lower while the dollar goes higher. Okay, and of course commodities are probably going to have to turn around as well, because these commodities, they're just at these prices where it's not sustainable. And think about it, if anything else in this world, if you look at our history and you look at thousands of years ago, what do we need? We need these commodities, we need these resources. So yeah, money, that can be changed, because quite frankly, money is an illusion. But commodities, you need those things. You need food, you need sugar, you need corn, you need oil. So those things are going to have to turn around, because somebody has to produce them, and we don't want them out of business. We want somebody to stay around to make a profit so that we can buy these things. Ultimately, we are consumers, and in the Western world, we pretty much can't do anything on our own, so we need supplies from supermarkets, we need convenient gas in our tanks and things like that. So at any rate, that's what I'm thinking is probably going to happen. And I know I'm taking a little bit longer, but the reason for that is because I haven't done a report like this in a while. And of course, when you come back after such a long time, there's a lot to talk about. And I promise next time my report will be shorter. But I wanted just to give you a background of what's going on in the markets. So essentially, everybody's buying the dollar because we essentially have this short squeeze going on, where everybody's worried that they're going to have to pay off more debt than they need to. So essentially, if the dollar keeps going up, that's kind of like saying that you have an adjustable rate loan, and that you're pretty much guaranteed that every day your adjustable rate is going to go higher and higher and higher. So if you're smart, you're going to try to find a way to pay it off. And so what they're doing is that they're buying dollars to protect themselves. And of course, other countries are suffering, such as Russia. And so a lot of these other currencies are falling lower. And so even others who don't necessarily hold any bonds, they're just looking for a safe way to invest, right? So when all of this happened with Russia last month, they were showing people buying things because they didn't know what to do, because their ruble currency was essentially dropping like crazy based on the news. And so they just went and bought things, and they were showing these stores, and the shelves were basically empty. So instead of doing that, a lot of smart investors in countries like that are actually putting money here in the dollar. So that's what they're doing. They're putting money in the dollar. And this is the first time where we're actually seeing downward pressure on the stock markets based on that. And all of this, of course, is tied to the bonds and the yields. So what's happening is that we were at a comfort zone with interest rates. We were sort of in a Goldilocks zone where things were just perfect, where it appeared that our economy was doing better, and it was in most aspects, and it still is. But now we're sort of having that hangover where we're seeing yields being pushed down lower. And if you look at the treasury yields, if you look at the 10-year and the 30-year, you will notice that while they're falling, they're actually nearing each other, meaning that the yield curve is flatlining. And that essentially means that there's more demand, that people are just buying these bonds. And so that's why bonds are going up and our stock market is going down, because they go in inverse. Because the bonds is really a safe haven. So what are people investing their money in? In the dollar, in gold. Gold has been doing very well, in bonds. So there's this fear out there, and people have been putting money into these other more safe assets where they're going to be getting a steady payment every 6 months or so in a bond. Whereas in the stock market, you just don't know what's going on, especially if you look at since the beginning of the year, we have really just chopped around. We go up and down and up and down, and it's been very volatile, and people are not used to this. And so a lot of people are saying, I don't want to be in this anymore, and they're putting their money into bonds. And that's what's happening. So I think what needs to happen is that we kind of need to shake this off for a little bit. We need to find a peak in this fear. And once we do that, we're going to find a bottom. Now, if you look at the spiders and you look at the weekly chart, or rather the monthly chart, and I apologize, I have a lot of lines here. But if you look at the monthly chart, essentially since 2009, we have been rallying up. Now you can make two cases. Of course, when a trend is going on, especially a strong trend like this, with all of these moving averages pointing up and moving in parallel, that's a very strong bullish sign. And so you can argue that we will continue. But on the other side, you have to say to yourself, well, we were at about $68 just 6 years ago, and from 68 we went to 200. Now think about it, that is a huge difference. Now of course, with the stock market, one thing that I have learned is that there is no limit to how high anything can go. So when I say, well, it has gone from 68 to 200, when I was starting out, that was sort of my clear sign. That was it. I have to sell it, let me short it, and it's impossible. So logic would tell you that you need to sell, obviously. But you just don't know how high it's going to go. If it could go from 180 to 200 in the last 3 months, why can't it go from 200 to 210 in the next 3 months? So see what I'm saying? So you never know how far a top is going to be. So yes, that is an argument, but it's only based on logic alone. With the stock market, you just never know, especially with the world now turning towards the United States. We have to look at how people are trading on a global scale now, and understand that as this volume is coming into a stock market, which we haven't had in a long time, it's probably coming from foreign investments, foreign interests. So you have to look at that, and you have to understand that now there is a demand for our market. So the question is, how much higher is that demand going to be? And of course, a lot of this is going to have to depend on bonds and currencies. As long as bonds keep shooting higher, and as long as we see these currencies whipsaw like crazy with these insane 5 to 10% moves, the market is going to be very volatile. and we're not going to know, but at the same time we will know that people will want to come to the to our markets and probably buy our dollar, and they will probably buy gold and things like that, whereas commodities will fall further. And the biggest thing that concerns me are the commodities, because as I said, that is something that we need. The market can crash and we will lose all of our money, but guess what? Humankind can survive with half of their money. Whereas on the other hand, if you don't get your resources, if you don't get your needs met, and somewhere a war starts based on this, because that's what's probably going to happen, then you have a lot more risk there. So the commodities are my major concern. So that's something that I want to see move higher. Now, of course, I don't think it's going to happen anytime soon because it's too big of a market to just suddenly turn around. But I think eventually we will see that turnaround. Now, having said that, the question is, what does this market do? So if you look at the monthly chart, you will notice, yes, we have been in an uptrend since 2009. And yes, you can argue, well, we have essentially almost tripled the value of the stock market in just 6 years, less than that. But you still don't know how much higher it can go. Now, what I'm thinking is that there will be one more peak. So if you count the peaks on the monthly, my argument is that we are currently on the 6th peak, or we're actually selling off of it, and that then we will have a sharp rally up. But I don't think that rally is going to be what people expect. And I think it will take out the highs, because based on my methodology, it has to take out the highs. So the high on the spider, for example, was, if I look at this, well, there was a fake print, but it was about 206, I believe. So I'm just gonna guess it, but it was about $207. Okay, that was the high. So what it's gonna have to do is get slightly above it. So it might make it to 208, or maybe even take out the 212. But I think as soon as it takes that out, as soon as that happens, we're going to see a sharp decline, because the market just doesn't have the energy to sustain this. So it's getting weaker and weaker and weaker, and there's a lot of people who are just waiting for that top, waiting for that momentum of buyers to come in, because we still have the buy the dip mentality buyers. But guess what? This is their last chance to take advantage of them for now. Okay? For now. And that is going to be when they sell. Now, I don't know, we might make another all-time high, but what I'm saying is that once we do that, in the immediate future, I think the market is just going to fall so sharply that it's going to take a while for it to come back. And so based on my reasoning, I think that we are going to make a high somewhere between February 28th and March 7th. So mark those, February 28th to March 7th. We are probably going to make a high. And then once we do that, my reasoning is a sharp decline on high volume, and we are going to see a lot more volatility then than we do now. So if you think this is bad, I think it's going to get even worse. And we're going to see these big moves of 400 or so points on the Dow on a daily basis. And the correction might take us down to the 170 or 165 level. That's what I'm thinking, but again, that's just too much far ahead for me to predict. What I can tell you is that I think there is a turning point somewhere in the beginning of March. We will see a high and then a sharp sell-off. That's what I'm thinking. Now, um, in the more near term, what I'm thinking is that we have a little bit more downside. Now, what I find interesting is that the market got very scared very fast. And if you compare what the market has been doing to all these things that have been going on in the world, I have to say that the market is actually holding up. And so if you think about it, yes, on a day-to-day basis, it's a lot of volatility, right? If you look at all this choppiness, but you have to think about the major things, the major events that have happened in just the last 3 weeks or so. I mean, these are unprecedented events. I mean, you look at the Swiss franc basically not holding the bottom anymore. You look at all these countries slashing their interest, and they do this overnight. They're very smart. They do this overnight in hopes that the market is not going to have a major sell-off. So you'll wake up in the morning, and it seemed like for the past couple of weeks I would wake up and I would go to one of those websites, and it will say something crazy like Denmark slashed their interest to negative 0.2, and then the next day you would get another news saying this same country did it again. They slashed interest again. So this just shows you how bad things are. And so Europe, I think, is in a lot worse of a position than it is. And I think that something is going to happen within a year in Europe that will be something that we don't expect. And the reason being is that while it's all great that they have the European Union and that they're trying to build this, I guess, nice society, the problem is that I think, based on what I'm seeing, is that every country still has the same economic policies, and you can't do that. And so one country might want one thing and another country wants another thing, and that just doesn't work. So imagine the United States, we're all using dollars, but then all of a sudden one state, I don't know, Minnesota, says, well, we don't want to participate in this policy. We're going to do a completely different interest rate. And then they do that, and it's kind of like they seceded, right? So it's kind of how Europe is working right now. And the best example, obviously, is Greece. And don't be surprised if one day Greece just says, well, we don't want to pay off all this debt. We're good on our own. We got tourism. Yeah, we're going to struggle for a little bit, but guess what? We were okay on our own before, and we're going to be okay now. So, I mean, it's a great country. They have a lot of tourism. So why wouldn't they survive? I mean, compared to some other countries in Europe, they're actually not that bad. They can survive. And so don't be surprised if that happens. So it will probably be a new shock, but then again, I don't know. A lot of it we have to kind of figure out. So the question is a lot of this priced in, or is it not? So what I'm thinking is that it's probably partially priced in. So we've had a lot of bad news, but the market actually is holding up. So with all this bad news that's been going on, we've only been trading between 200 and 210. So if I told you a couple of months ago, hey, listen, you're going to be trading on the spiders between 200 and 210, what do you think is going to happen in the world? And you're probably going to say, well, nothing, right? Because it's only a 10-point move. And yet look at everything that has been going on. Unfortunately, all these different attacks that we've been seeing, all this military instability, So when you think about it, the market is actually holding up. And if you look at it right here, you might even make an argument that it's putting in a bullish consolidation. However, based on the selling we've been seeing in particularly the last 4 days, the last 4 days, we've had some very volatile gap downs. So I'll show you what we've had. So here's my reasoning. We had a major gap down and the market sold off. Then we had a really big wide range bar. Okay, this one was sort of a little bit of positivity here, but not good enough. And then yesterday, or rather Friday I should say, we gave it all back, but it was interesting how we gave it all back. So if I look at the intraday and go to the 10-minute chart and just kind of show you what's been going on. So here we had a major gap down day, right? And we tried to rally, but then we closed flat. Very, very weak. Next day, a gap up, but a much smaller gap compared to here. So that already in itself is weak. And the rest of the day, we just basically fell. So this was your wide range bar. And then on Friday, what happened is that the market tried to rally, but literally within 2.5 hours, we went from 200 to 199. So if you think about it, you went from 202, to 199. So a 3-point move on the SPY in 2.5 hours on large volume. So this was a big seller coming in, and even here, if you look at this volume, this was all big volume. So people just don't want to hold at the end of the day. They don't want to hold into the weekend. Why? Because they wake up like I do in the morning and they see this bank did that, this country did that. So essentially currencies are all over the place, and so people don't know what to do. And so any rally is just not sustained anymore. And that's why, yes, in the morning you might see a gap up, and yes, by the middle of the day you see a little bit of a rally. But guess what? Once 1 o'clock, 2 o'clock comes in, reality sets in, and people are saying, I don't want to hold this anymore. And that's what's been going on. So essentially it's all based on news. That's what it is. It's all based on news. When you see these late day sell-offs, it's all based on news. I will say, however, just going into Monday, that the market seemed to be somewhat oversold. And so we've had essentially, if you look at the daily, we've had 3 tries to sell off this market, right? So we've had one here, actually 4, one here and one here. So this is our 4th try to sell off the market. So if you think of it in terms of where the money is and who's in this market, it will tell you that most of the sellers here have already sold off their stake, right? So most of it is already sold off, and that last little bit on Friday that we saw was probably just fear, and it gained a little bit of momentum, and that's why we saw that, right? But nonetheless, it was high volume, so it was probably a big seller, right? Or multiple big sellers. So there is some selling here. But I think into Monday, because it's just too much selling, into Monday we might see a gap up. So the market might see a little bit of a gap up, especially since the stochastics here are getting a little bit lower, so that's good. And particularly I'm talking about the 10-minute chart. So if you look at the 10-minute chart, it's extremely oversold, and so probably buyers will come in and we might see a gap up into Monday. But the question is, how sustainable is it? I don't think it's going to last very long. So if you look at anywhere here in the past couple of days, so every time we had a gap up, we essentially sold off. We had a gap up, we sold off. Gap up, sold off. Gap up, sold off. So I don't think that's going to change for now. So we might see a little bit of selling into Monday, but I think Monday and Tuesday probably, buying into Monday morning, and then probably late Monday, Tuesday, we might see some more selling. But the question is, how long is that selling going to go on for? And so I have two possible scenarios. The good thing about the market is that it's actually in support. So if you go back to the daily chart, what you're going to see is that we kind of have this bullish consolidation. And so we're creating this triangular pattern here. The only problem that I have with this pattern is that, well, number one, it doesn't look like a real bullish consolidation pattern should. It's not as perfect as it should be. It's too volatile, and I would have liked less volume here. But the idea is that nonetheless, it's still there. So if you can hold this level, this 618 fib retracement, which is 198.64, if you can hold that, and even if you don't hold that, if you can hold this low right here, which is 197.86, if you can hold that by Monday or Tuesday, if you can reverse off of that on Monday or Tuesday, and I mean a big reversal, I don't mean a small reversal, I mean we take out all of the red in this Friday candle and then some more, if you can have that reversal, then the market is probably going to go back up and it's going to trade in a more narrow range. The reasoning here is that who has sold has already sold, so the volatility is out of the market, and therefore the triangle gets more and more narrow. And if it does that, we're going to shoot up. And that's why I have these two blue arrows. So that's what might happen. And just be aware that it is possible that we might see more downside. So the question now is, how do we come into the level to shoot up higher? So one is what I just explained with the triangle. So the triangle could just have a more and more narrow range of trading, meaning volatility goes down, things calm down, maybe earnings are going to start being somewhat lukewarm now, maybe we won't hear anything out of Greece, which I doubt. Maybe the ECB is going to calm down based on the QE. They're going to be quiet while they negotiate what they're going to do. So there might be somewhat of a down, sort of quiet period for the next couple of weeks while we trade in that tighter range, in that triangle range. And then based on this level here, 198.64, we might bounce off of it. So we might just trade sideways into that triangle, but then eventually bounce. Because if this is going to go up, it needs to consolidate a little bit more. For me personally, if this is a bullish consolidation, I mean, it's a very weak bullish consolidation, but if it is one, then it needs more time. This is just too short of a time span. I would need a couple more weeks at least. But the idea is that that might happen. So if you see that triangular pattern, it's going to take a long time to develop because we need to develop that bullish consolidation. And then we might see a reversal. I don't know when, but I'm thinking probably towards the end of February, right? Maybe a little bit sooner. And then a sudden spike up out of the triangle, which would take us into a new all-time high in the beginning of March. That's one thing. So this one is less volatility, tighter trading range, but it will take more time. That's the first scenario that I have. Second scenario are these two arrows that I have drawn in. So if there are still sellers in this market, and based on what I'm seeing is that there might be, because we've been hitting this 618 retrace, gosh, for over a month. So we've been hitting this level and hitting it, and so it's possible that it goes down lower. Now where it goes, that's the question. So does it bounce off of this 200 moving average, which is also another possibility, or does it go down lower? And what I have is I have this 382 retracement, which is at about 192, but we also have this gap right here. So it's possible that we bounce between this 190 and 192 level. So I can't tell you exactly where because there's all these different levels here, but around that area. So that's our next scenario. However, that one would be more immediate. So when you think about selling, when there's selling pressure, it happens very quickly. So you would see big red wide range bars very soon next week, and then we would just go lower and lower, break below that 200 moving average right here, and go somewhere, find support somewhere here. Where? I don't know yet. What you need to look out for is volume. So if you see a spike in volume on the daily, then you can probably get in on the long. So that's another possibility. And then we shoot up, but now it will take longer. Okay, so what I'm trying to say is that we're still looking at the late February to March 6th time frame. It's just about how we create that pattern. So if we do the triangle pattern, we're gonna trade sideways for a longer period of time. So that's where we're gonna take the time, right? But then it will spike up quickly because that's what a bullish flag does. It's a quick spike to the upside. Still going to be within that time frame. Or if we go down lower, right, what we're going to do is we're going to go down suddenly because we have more fear in the market, and we're going to have big red wide range bars. We're going to come in here somewhere into this level, and then we're going to go up, but it's going to be slow. So whereas the bull flag would just be parabolic, here we're going to have to get through some resistances, right? Because we're climbing back up a ladder versus walking up a staircase, right? The bull flag is sort of a staircase because there's going to be less volatility. We're going to be within that triangle. But if we go down lower, guess what? We don't have a staircase anymore. We have to climb up a ladder now. And so we're going to have to get through resistance one by one. We're going to have to get through this retrace. We're going to have to get through that retrace. We're going to have to get through the 200 moving average. We're going to have to get through these double, triple bottoms. We're going to have to take care of these gap windows and all these different things. And so it's going to take a little bit longer. Either way, I think beginning of March, around that time frame, of course I could be wrong, but I think that is when we start seeing some positivity. Now, of course, I might be wrong, but that's what I'm seeing. I don't see the market reversing on Monday. It's just too much volatility for me. It's just been too negative for me. And what I'm thinking is that it's going to take some time. The question is, do we go down lower into that 191, 192 level? Or do we trade in that triangle and then break out into a bull flag? But either way, the target is still the same. I think the target is to take out the all-time high just by a little bit, not much, just by a little bit. And then we're going to have a sharp sell-off. So that's what I'm thinking. I'm looking at my notes as far as here. Now my notes are a little bit interesting because I look at different factors and I just write by each. It's either bullish or bearish, and I just add them up and figure out what the overall sentiment is. But I'll be honest with you, with this week it's been all over the place. I have things saying bullish, things saying bearish, but ultimately on the longer time frame things are bearish. So you might see a little bit of an uptick based on the oversold condition early next week, but don't let that fool you. So if the market is going to reverse next week, you have to be very demanding in your signals. So don't just say, well, it closed 1 cent above this candle. No, you have to demand a lot of different things. You have to make sure the volume's there. You have to make sure you have green wide range bars. You have to make sure that you close at highs of the day at 4 p.m. You have to make sure that the stochastics are with you, so you have to look at everything. So in this market, you have to be very picky and very demanding if that's going to be a bottom. Otherwise, expect that triangle that I just talked about, or expect further downside. Now, I want to talk about the NASDAQ. So let me pull up the triple Qs. So the triple Qs are sort of doing the same thing, but I'll be honest with you, the triple Qs are looking better than the spiders. The Dow Jones is looking the worst. Well, of course, if you look at the IWM, that one's not looking all that great, but the Dow Jones and the IWM are not looking that great. Spiders are somewhat medium, but the Qs are the best of these. So here we have a more pronounced bull flag. So if you look at the daily, here we might see the same thing, but here what the interesting thing is that the triangle pattern is actually looking a little bit better. So here you can imagine the triangle pattern a little bit better. Now of course I could be wrong and it sells off, so what I'm thinking is that if it goes down, it's probably going to go into the 200 moving average, although I don't think it's possible. I honestly don't think it's possible. I don't think it should trade lower than 99. Okay, so that's what I'm thinking. I don't think that it will take out this bottom here, whereas the spiders actually is trading here. So the spiders is already trading at its level here, at its equivalent, but the NASDAQ is not. So the NASDAQ has is looking a little bit better here. And so what I'm thinking is that look for the NASDAQ to tell you what's going to happen, because once the NASDAQ moves, then there's a likelihood that the rest of the market is going to do the same thing. So if you see the NASDAQ breaking out of a triangle as opposed to breaking down lower, then that might be an indication that the rest of the market is ready as well. Now, what I need to talk about is oil. So oil had a very interesting day. So if we look at the USO, so of course everybody's trying to call the bottom on the USO, and whether this is a bottom or not, I don't know, but I'll tell you that the stochastics look very good. So right here it looks very good. So finally we're seeing a little bit of a reversal on the stochastics. And if you go back in time now, let me see here. So if you go back in time and you look at the MACD divergence, and you look at how negative we are right here. Now of course this goes for the whole year, but when's the last time we did that? We did that in 2012, which is when we had a big downfall and then rallied higher. But we've never really seen anything like that, right? So here's another one in 2008, right? So this was the big kind of downdraft. So we've seen this in 2008, and it's a very similar MACD right here. So the idea is that it's possible that we're seeing a little bit of a reversal. But if you look at 2008, what actually happened? So if you look at the MACD, it went from -7 all the way to 0. And yet, what did the price do? Not much. I mean, yeah, you had a reversal, but it was just trading sideways, right? For years and years to come. And so the idea here with current action is that, yeah, you know, you have the MACD going lower, and it's probably finally finding a bottom, or at least it seems. But the question is, can you really expect that much more upside? And my answer is no. My answer is no, just based on what I saw in 2008. And so oil, when it trades lower, it just stays like that. That's how it is. And it stays like that for many, many years. Now, of course, it has to be taken in context, excuse me, with the rest of the commodities. And so if they start going up, the question is, well, will oil go with it as well? So just a question to ponder, but my idea is that I don't think it's going to go up very much. Now, of course, it's extremely oversold, so you might get another pop, and if you are in it, congratulations. But I don't think crude is, a lot of people are saying it might go up to 60, but to me, I don't think crude is even going to get above 52, 53. It just doesn't look right to me. But I might be wrong. Hopefully I'm wrong, but that's what I'm thinking. 53 at the most, and then you're going to struggle. But nonetheless, so we are seeing um, an uptick. We did see a little bit extra volume, so that's good. But now the question is, can it continue on Monday? Okay, can it continue on Monday? So that's the whole idea. And in closing, since I'm taking up a whole hour of your time, I want to give you a preview of what's going on next week. Next week, we're going to have a lot of economic data, a lot of focus on employment, on housing, and a lot of focus also on wage growth. And so be careful with that, because that has been a negative in the market. And so if we have another report telling us that there's no wage growth, the question is, how is the market going to react? Is it already priced in, or is it going to fall further, or is it actually going to be a positive report? We also, I believe, get GDP numbers, and of course those have been weak recently, but again, maybe a lot of this is already priced in. I mean, there's only so many times you can repeat the same news, right? Another thing to watch out for, Monday, very important, at 8 a.m. ExxonMobil is releasing their numbers. So this is appropriate with the USO chart being up there, but be very, very careful. USO could reverse all of its gains on Monday if ExxonMobil has a very, very bad report. Of course, it could pop very big. So I think oil is going to be very volatile on Monday. So be ready. Have your stops in place. Just make sure you're in the right direction if you're going to let it run. Tuesday, we have Disney and Wynn Resorts. Wednesday is a very heavy earnings day, so be very careful on Wednesday. Wednesday might be a gap up or gap down day in the morning. We got GM, Humana, Merck, Yum, Ralph Lauren, and a lot of different things. And it's interesting, I noticed on Wednesday a lot of healthcare stocks are reporting. So also be a little bit careful with the healthcare stocks. So we just don't know where the top is in those. So beware on Wednesday. Thursday we got, I think Thursday might be a positive day just based on the companies that are reporting. We got Expedia, GoPro, LinkedIn, Sprint, Twitter, among many others. And so that might be a big day, especially for the NASDAQ. Friday, I don't think anything is happening in terms of earnings, but I think we got some economic data. Probably, I'm not sure what, but I know next week the GDP is coming out, unemployment is coming out. I also know some housing numbers are coming out, natural gas inventory, and a lot of those other things. Just make sure you look it up. And in this kind of environment, even though we're technical traders, well, guess what? We have to know what's going on, because apparently right now the news are moving the market as well. So take care, everybody, and I'll try to post another video hopefully sometime next week.